Paolo Pellegrini is not your typical hedge fund manager. For starters, he's the guy who figured out the subprime mortgage trade that made John Paulson's fund $3.5 billion in 2007. Now that he's on his own, Paolo's not just making money, though he is up 80% this year. He's also fighting for what he considers the greater good, a fair market for all investors and a just economy for all citizens. Paolo doesn't believe in policies that benefit the few at the expense of the many, but he says that's exactly what we've got now, right here in the United States. Paolo Pellegrini is here to tell us what's wrong with the way Ben Bernanke and Tim Geithner are trying to fix the economy and how he's investing to profit from it. Paolo, it's wonderful to have you here. Let's talk about the policies. We're witnessing them day by day by day. Quantitative easing, fiscal stimulus. A lot of people say Ben Bernanke is doing a great job. That's what you hear on Wall Street. What's wrong with what they're doing?
Well, at the end of 2007, when I had already made a fair amount of money, and but sort of the country was not in the same kind of shape it is now.
Which is to say, it was better off then.
Much better off. Sort of household had about 78 trillion of assets and 14 trillion of liabilities. Today, so the same households have about 67 trillion of assets, so they've lost 11 trillion. But they still have the same 14 trillion of liabilities. So there's something that, sort of an indication that not much has been done, in fact, to improve the situation of households in terms of all these economic policies that have taken place.
So why are fiscal stimulus and quantitative easing the wrong approach to fixing that?
Well, I think that what should happen is that selectively, out of that 14 trillion of liabilities, maybe 4 trillion should be written down. Sort of approximately 30% less liabilities. So what they're trying to do is, in fact, say, okay, so let's try to achieve the same result. Let's keep the 14 trillion and inflate the 67 trillion to something like 90 trillion.
So you restore the balance that way.
So basically, you restore the balance. Now, I don't think that that's practical. I don't think that's going to happen. I think that there are, political impediments to sort of handing out $25 trillion to, sort of even in nominal terms. And so, I think it's a tricky situation. I would expect that, in part, that will translate into certainly some, asset inflation, some of that. At the same time, it also result in some, sort of decline in real economic activity, in real, wealth, and sort of everybody's going to, suffer from that.
We're talking about the U.S. economy, of course. What about the dollar?
Well, so I think that part of this strategy is that either you're going to have a depreciation of fixed income assets in nominal U.S. dollars, or if they don't depreciate in nominal U.S. dollars, then the dollar will have to depreciate to sort of fill, the gap. So it's kind of like, I'd say that probably the simplest way to put it is that, for example, U.S. Treasury obligations will decline measured in international currencies or commodities.
Paolo, just hold on to that thought, because we're going to take a short break, come back, and talk about how you're positioning your fund in light of your views. We're talking with Paolo Pellegrini.